Hi, I'm Richard Brown, Chairman and CEO of JNBA Financial Advisors in Minneapolis, Minnesota. It's January 8th, 2026. Joining me are fellow investment committee members Michael Bellata, John Foster, and Mark Rosenkrantz. Welcome, gentlemen, and Happy New Year.
Happy New Year.
Happy New Year to you.
Happy New Year.
On the surface of what was a very strong 2025 for both stocks and bonds, the year featured a large amount of volatility. A strong decline followed by a rapid comeback in stocks, and a dynamic rate environment with renewed Fed activity brought a shifting landscape in bonds. Mike, with such a back and forth year, how would you summarize what went on in the equity markets for 2025 for both the US and abroad?
Yeah, that's a good question, because it's where the year ended up was certainly not the path that it took over the course of the year. In fact, in the beginning of the year, for the first third of the year, it was quite dicey. But first, I should just mention, before we move on, a couple of major transitions in 2025 saw the migration of power from not only President Biden to President Trump, but also the retirement of 95-year-old Warren Buffett, who, after 60 years at the helm of Berkshire, hung up his spurs. And so just to pay homage to one of the greatest investors of all time, Warren Buffett, I'd be remiss if we didn't do that to kick it off here. So
very true.
From the perspective of equities, it was a nervous first part of the year, I would say. From February 19th to April 8th, as we were transitioning the power of presidency from Biden to Trump, and then also leading into Liberation Day, the market pulled back about 19% in total. 15% of it, by April 8th is where we were down on the year total. So April 8th, S&P 500 down 15%, which was one of the worst starts to a year that we've ever had, with most of that coming right away post the Liberation Day tariff party for everybody announcement on April 2nd, where the market fell 10% in the next 2 days. After that point, however, some of the tariffs got negotiated, some of them got postponed, some of them got revised, that sort of thing. And so in the next 54 days, the market recovered all the losses that it had leading up to that point. Which, again, if we pass that without mentioning, that's a very good exhibit A, if you will, of why you stay invested. Because it was a very emotional time, a bit of a nervous time, too, as you get to, hey, we've got the new tech, we've got a lot of global things happening, we've got a new president, and it's very easy to want to kind of get out of harm's way and let things settle down and then kind of go back in. Well, you would have missed it. By the end of the year, the economy continued to hang in there. The corporate earnings continued to deliver. And at the end of the day, why you own stocks in the first place is because of the earnings that they deliver. So, a 37% rally from the end of that decline through the end of the year. And we ended up with an S&P 500 that hit 39 new highs along the way and ended up with a return of just about 18%. So a very good year, but again, the path was a little bit interesting, to say the least. As far as AI stocks are concerned, they take all the news, but if you look back at 2025, only 2 of the Mag 7 outperformed the S&P 500, and that was Google or Alphabet and NVIDIA. Google returned 65%, NVIDIA 39%. But those were the only 2 that outperformed the market. So Apple and Amazon, probably 2 of the most well-known names, actually returned only single digits, with Amazon coming in at only a 5% rate of return. So there was a lot else happening outside of the Mag 7. Again, another atonement to why you want to stay diversified and stay allocated to different areas of the market, even when sometimes it might not feel like the right thing to do. One other aspect on diversification, international and emerging markets took the lead for the year. A couple of setbacks along the way, like we would expect, but the valuations were good coming in. The economy stabilized in a lot of those areas. The companies coming in with reasonable earnings led people to now look at international markets again, and along with a 9% decline for the U.S. dollar. The international markets returned between 30 and 35%, depending on where you look. So again, having that swath of international and emerging market exposure within the portfolio helped greatly over the course of the year. So very good year for diversified, globally balanced portfolios in 2025.
Yeah, I would agree, Mike. It's like you say, you've got to be in it to win it. The way that we devise our portfolios, this was such an exciting year for us because it does give us opportunities with the way that we look at portfolios every 10 days to understand, should we be peeling off some of the wins that we have and putting them in the undervalued areas. And if you keep the emotions out of it and you stick to the strategy, uh, almost all the time, most of the time, you'll win. And the whole idea is to really be strategic and stay focused on the portfolio, diversify, and just let it ride. Our job is to obviously pick the right investments and take a look at when we want to move something out and move something else in. And we do that. We meet, either daily sometimes or weekly and make sure we stay on top of it. But a diversified portfolio that is actively managed that we're looking at on a regular basis is still the way to go. So thanks, Mike. That was really some great information. John, while stocks typically get a lot of focus, bonds were particularly interesting this year as well. With the Fed resuming interest rate cuts, what were the key factors that impact overall bond return for the year?
Yeah, Richard, you might recall at the start of 2025, we thought you'd probably pocket the yield on bonds and maybe get a little bit of capital appreciation on lower rates. Filed it under, I guess, broken clock, right, twice a day, as that's actually what did occur throughout the course of the year, right? We saw interest rates come down, people pocketed the yield, plus get some capital appreciation on bonds for the year, which pushed the bond index up 5.2% on about a 4.5% yield. So, people got 4.5% coupon, 2-3% of capital appreciation, giving people a 7% plus return if they're invested in the bond index. A lot of our active bond managers, in fact, I think all of the active bond managers we use, where they're taking a little bit of credit risk, outperformed that index by varying amounts. So it was a really good year for fixed income, especially good for global fixed income, where we saw double-digit returns with that dollar weakness. But it was really 3 rate cuts that had people positioning ahead of them. September, October, and December, the Fed cut interest rates. 3 rate cuts causing rates to fall. A 2-year note began the year at about 4.4%, fell to 3.5%. 10-year note began the year at 4.7%, fell to 4.1%. Almost all of the drop or decline in rates, though, was ahead of the rate cuts. It was all in anticipation. Once the Fed started rates, the 10-year note was basically unchanged, sitting right around, 4.1 to 4.2%, bouncing around in that range. And the 2-year note only fell from 3.6 to 3.5%. So a 10 basis point cut in the 2-year note following a 75 basis point cut in short-term rates. And so we've talked a lot about it, where the Fed doesn't really do a whole lot but follow the 2-year note around. And we talked about, hey, the 2-year note was sitting at about 3.5% last year, and Fed funds was sitting up at 4.25% throughout the year. We expected those to converge, and that's what happened. But it led to a real good year for fixed income investors, up 7.2% plus, depending on their strategy there.
But that's interesting that you say that, because it is often the skating to where the puck's going, not where it is. And so we've talked to investors about, hey, by the time the event happens, it's going to be too late to position that way. Mm-hmm. And that's the way it was within bonds, where as long as the bond market is expecting something to happen, they will position ahead of time. So if you wait until that event occurs, you're too late. Yeah. And so that's why it's important, again, to try to be a little proactive and adjust, as I said, where the puck's going, not where it is.
Well, it's sure fun to see stocks and bonds up. Quite a change from a couple of years ago where they weren't. And so it does feel good and feel much better. While it's always helpful to review the most recent year, the big picture matters as well. The world and the markets have been on new ground since the onset of the pandemic. Since then, we've had several periods of extreme strength and weaknessing for both stocks and bonds. But when we look at the overall returns, since many of the clients have been surprised by how healthy the results truly are. So, Mark, how do you and the investment team balance the short-term environment with the context for a longer-term portfolio?
Yeah, I think it's a good question. When I kind of think of that long term versus short term, it kind of comes back to two aspects of really setting up a portfolio, and that's portfolio construction versus portfolio management. The construction is kind of what's tied to why clients come to our door in the first place. They want to set up their portfolios to meet their long term goals. In order to do that, we construct a portfolio based on their ins and outs and their financial picture of how we can best meet those goals. That has the typical building blocks of diversification, income characteristics, their risk tolerance, all those key aspects to set them on the path to meet that long-term strategy. Now, as we get closer to that medium term and the short term, the day-to-day management, that's more of the portfolio management. Once we have that core in place and we have those kind of confines set, that's where we can, look to see how we can tweak the aspects of the portfolio on a short and midterm basis to deliver more optimized client outcomes. And I think there's two aspects of that. A lot of it is the maintenance aspect. You mentioned it, whether it be low cost, tax efficiency, the key holdings in there, but also has a lot to do with what you touched on earlier, rebalancing. This was a very important year to be rebalancing, and we certainly saw a lot of value in that, especially in the April decline, where we were able to not only reposition portfolios to stay on that long-term path, but sell out of some outperforming assets and into underperforming assets to really take advantage opportunistically while also keeping the portfolio on track for performance. The other aspect of portfolio management is that tactical component, and that's where we look at, the stock versus bond positioning. We look at active managers, understanding the underlying factors or exposures to various themes that are at play of the portfolio. Things like AI. What's our exposure not only across our various equities, but across all our sub-asset classes, international and U.S. and large, mid, and small caps. Understanding what common traits, even when a portfolio appears diversified on paper, there still could be some factors at play. And I think all of that kind of ties back into the day-to-day management within the confines of that long-term plan. So when you think about the short term, we typically look at that 1 to 3 year picture of where can we be, opportunistic portfolio management and the maintenance aspect of it, but also in the tactical aspect of it. But I'd say, from my seat, a lot of the important change we make for the short and midterm kind of goes back to the advisor seat and is marrying that kind of long-term plan with what's going back with each individual client and what's going on in their unique circumstance and planning for the next 1 to 3 years and how can we optimize their specific portfolio versus just the broad assets under our management. Mike or John, so what would you add to that in terms of how it looks like from your seat as the advisor really working with clients day in and day out?
Yeah, I can just take that first. And kind of briefly, it's first of all, one of the main benefits that we provide for people is to take the emotion out of the investing. We talked about that a little bit earlier too, when I was, talking about selling out at less than opportune times or whatever. But it's really, and you talked about constructing the portfolio for somebody's long-term goals, objectives, and so on, and continuing to manage and maintain the portfolio along the way as life changes, as the world changes, and so on. But it's really also when risk comes into play, it's how much risk can somebody tolerate is one thing. How much risk do they need to take is something else. How much risk do they have the ability to take can be something else entirely. And so it's coming back to say, well, let's have the discussion around, okay, you're risk tolerant, but you really don't need to take that much risk to obtain your goals and objectives. So let's be a little bit more moderate here. Or, because you are risk tolerant and you need the risk in the portfolio for higher growth numbers, let's be a little bit more opportunistic and let's be a little bit more aggressive. So I think from that perspective, it's really making sure that you hone in on that individual person or family's not only goals and objectives, but also the way they view the situation and also what they need to do at the end of the day to accomplish those goals.
Mike, too, I think you had mentioned that idea of keeping, your emotions out of investing. And, we'll tend to focus a lot on, people's, more maybe strategic long-term allocation in terms of how are we going to get the consistency of return over time, as well as a little bit of, Mark, what you were talking about, maybe some tactical allocation where times we want to own more stocks versus less stocks. But you had mentioned earlier what a strong year it was for foreign stocks. And really, if you look at the various, MSCI or the various regions that make up the globe for investing, 6 of the last 7 years, the U.S. was the number one performing region. And there was certainly no reason coming into 2025 to think that that was about to change. And yet last year, for the first time, in a long time, The U.S. was actually the worst performing of those regions. A very strong return, up 17%. But every other region, right? You had Canada up 37%, as you had mentioned. Emerging markets were up 33%. European stocks were up 34%. We just saw real strong performance across the globe.
Yeah.
And there wasn't necessarily anybody saying, okay, well, we're about to get real strong, performance from these other regions. So I think that's some of that, taking the emotion out of it, taking the discipline out of it, and really looking at a market where you say, you know what, international stocks will typically trade at 18 times earnings. They entered the year trading at about 13 times earnings with a 3.5% dividend yield. So, about twice the yield of the U.S. and a significant valuation discount. And that combination of low valuations, a little bit of momentum picking up, and a weak dollar, led to these returns in foreign stocks that were, close to twice that of U.S. So,
and
that's that really disciplined approach that we're talking about there.
And that's something that you need to have before that occurs, right? And I think that was one of the maybe more pleasant surprises throughout the year, meeting with some clients in that April period kind of before the big rally, was a lot of clients coming in, looking at the headline numbers, how the S&P is doing, and say like, all right, tell me what the damage is, and kind of looking at where their portfolios shook out and being pleasantly surprised. Certainly not great, but not down as much. And that was kind of a really rewarding kind of period of showing that value diversification. And that gives flexibility to the clients to really understand, where we're allocating, how they can perform in different environments that you can't really anticipate ahead of time. But if you're not there to start the year, then you don't get those benefits as you go through those periods.
Yeah, if you think of the first third of the year, as you had mentioned, called out, Mike, with stocks down, in the teens, a diversified portfolio that had, call it 30% in bonds and 30% in foreign stocks. Well, they had 60% of that portfolio that was higher, while U.S. stocks were down. And so that idea of diversification, at times it's frustrating because you might miss out on the best performing area, because now you can sit here today and say, well, why wasn't I all invested in Canadian stocks up 37% last year? But there's nothing saying that was about to happen. And that's that idea of diversification. You'll take away some of that downside volatility, but over time, you're not necessarily going to get the highest level of return, but you get more consistency of return over time, taking out some of those peaks and valleys to really get clients where they need to go, a little bit regardless of, the environment, regardless of what areas are performing the best.
Yeah, the sleep at night factor definitely does have a value to it.
Well, that's a great lead in. We talked a lot about the process of JNBA and how we can succeed for our clients in the long run. But it's only natural to wonder what the rest of the year could bring. So, John, Mike, and Mark, what is the area or data point you're monitoring which you think could shape returns in 2026?
Where to start?
I don't think there's a wrong answer.
No, there's quite a few. I'll let you guys jump in and
sure
pick one.
We'll let Mark go first this time.
Sure. Well, I think, Mike, you touched on at the start, how strong of an earnings year it was, right? And when I look at earnings, I think we've always talked about in a lot of our writing about the core tenets of long-term economy, whether it's corporate earnings, unemployment, or inflation. And I thought a notable trend in 2025 was underlying the earnings was profit margins. The S&P 500 had profit margins through the end of Q3, which is the earliest quarter we have reported of 13.6%. That's an all-time high in terms of corporate profitability. You look at the long-term average since the start of 2000, that average is about 9.1, and really from about 2000 to 2018, that averaged more about 8%. So compared to the 13.6% now in terms of profit margins, that's been a lot of the driver for returns in 2025. You look at the 18% return on the S&P 500, 3% was valuation multiple increase. The rest of it was profitability of corporate earnings, 15%. And when I look at going forward into 26 of how that could impact markets, that's a high bar that delivered that earnings, is that high profitability, record high profit margins, right? And if that's sustainable or not is the kind of big question for markets of where they can continue to drive, further profitability increases. And that profit margin also plays a lot of aspect in the kind of two other aspects of the economy that we talked about, unemployment and inflation. If there's higher inflation due to tariffs or other costs of goods, things that could drive up prices, do they have that profit margin shield where they could perhaps bear some of that cost, or do they still need to pass to the consumer? In terms of unemployment, if they encounter some headwinds in the business cycle or weakness in the consumer environment, do they immediately need to react to laying off employees or controlling the employment structure, or can they bear some of that? And it all comes back to how important that valuation aspect is for how important earnings are and how profit margins can continue to expand or at least maintain to deliver some pretty lofty expectations.
And I don't need to pick up the next point, but that's where AI would come into play too, is, this could very well be a make or break year for the tangible evidence that people need to continue the AI trade. Is, are companies going to be able to incorporate it to enable them to maintain profit margins in the midst of all of this? So, there's been a lot written lately about a lot of the financing of some of these companies, how they've had to go to the debt market, or they've done some of the circular financing where company A gives company B the money to buy company A's products or whatever. And, a lot of that happened at the tail end of the dot-com bubble as well. But I think, short of stating the obvious, I think at some point before too long, and 2026 is probably a logical year for it, you're going to need to see some evidence of some of this working, so to speak.
And I think you had hit on one of the other points, which was really inflation, right? For the most part, we've been in a falling environment as it pertains to inflation. You go back to 2022, inflation rates, topped out near double digits for a variety of reasons. A lot of stimulus that was in the system due to the COVID response, a lot of supply chain disruption, et cetera, right? There was a lot of factors really leading to imbalances in supply and demand. We've had steadily falling inflation basically from fall of 2022 through, call it today. But a year ago, you go back and look, September of 2024 was when inflation bottomed out. It was 2.4%. Well, guess what? Fed funds was 4.75% to 5%, right? So the Fed funds rate was 2 times that of the inflation rate. The Fed had a lot of room to cut. Their policy was very restrictive. It was very likely that that was going to keep, inflation at bay when your inflation rate's about twice that, or your inflation rate is about half that of the Fed funds rate. You look at today, and we now have a Fed funds target of 3.5% to 3.75%, and inflation's it's been bouncing around between about 2.5% and 3%. Call it. We got most recent readings around 2.9% on inflation. So we have some room to cut, and the expectation is that we're going to get 2 Fed rate cuts this year. But there's not that buffer that there was before, right? It's not a super restrictive Fed policy. It's a much more fair Fed policy today. And is that Fed policy going to be restrictive enough throughout the year to keep inflation at bay? Or is there going to perhaps be, a little bit more inflation that yet to come, because there's just not that, real restrictive policy like we've had in the past.
Well, directly pertaining to that, we're going to transition to a new Fed chair in May. So that'll be kind of, could be a politically charged appointment, also, as well as the president's made it clear that he wants as low interest rates as possible. So, what does that transition to a new Fed chair look like? It's a midterm election year, and we don't have to look too far to see that this is a very politically powder keg type of environment, and has become more so as we've gone on here. So the market typically does have a fairly decent drawdown in the 12 months leading actually up to the elections themselves. So will that happen again this year? The average drawdown in over a 12-month period leading up to that is almost 18%. So, something again to prepare to. And I think one of the things that's back in the news that I wouldn't have imagined that we would have had to talk about today is some of the geopolitical environments that have taken place lately in certain areas around the world, and certain discussions that are happening about potentially Greenland and other areas. So the question would be, I suppose, is does that embolden China, for instance, as they look toward Taiwan, something that they've wanted to do in the past? What does that embolden them to take extra steps that they would have not have taken possibly even a couple of months ago through this discussion? So something that we'll continue to see and it will evolve, but I think it's back on the table a little bit more now than it probably was to start the year even.
Such good information. Thank you, Mark, John, and Mike, for the great conversation today. And thank you to our listeners. We hope you will visit jnba.com and tune into our other podcasts and videos. Thank you for your continued trust in JNBA, not just as your financial advisor, but also your advocate.